Good morning to every one of you. Today we are going to study the super profit method of calculation of the goodwill. This is in the chapter valuation of goodwill and shares. So already I have posted one video related to the valuation of goodwill on the basis of arbitration method and average profit method. This is the second video, and super profit is the difference between the actual profit and normal profit. Actual profit should be greater than the normal profit. Then only super profit will be there. That means the concern is earning that more than that of the industry, earning given by the industry. Thereby, we have to calculate that normal profit, actual profit you can derive from the past records or 1 year current sales, current profit, or past average profit. Past year's profit can be taken and average profit can be taken into account. Average maintainable profit in future can be calculated. Then super profit, normal profit is the capital employed into normal rate of return. Normal rate of return is a return given in the industry in which the concern is functioning. Then that normal rate is suppose 13% and capital employed is 5 lakh, means 5 lakh into 13 by 100 will be giving the normal profit. But the actual profit should be greater than that to know the goodwill. And from the super profit, it may be multiplied into 2 or 3 times to get the goodwill. Now, it has been represented and explained in 2 illustrations, that is illustration 5 and 6. When you are seeing the illustration 5, you find that there is a need for calculating the average profit and also tax, actual profit. Actual US profit has been given and that was added and average has been taken and the tax 40% is deducted. That is the actual profit. Then that normal profit is the capital employed you have to calculate. Capital employed is the total tangible assets minus liabilities. Liabilities in the sense that short-term liabilities, not long-term liabilities. That is current liabilities only should be calculated. And otherwise that capital employed is that equity share capital plus preference share capital plus debenture plus loan and then all resource and surplus minus intangible assets represented in the asset side. That is like that the intangible asset and fictitious assets. That patent right, trademarks, intangible. Then fictitious means deferred revenue expenditure, discount on sale of discount on issue of shares or debenture are to be deducted. Like that, any accumulated loss represented in the balance sheet that should be deducted means you can find the capital employed. So two ways of calculating. Here we have applied about the total of the tangible asset minus liabilities. Then that capital employed is calculated, and from that 13% is applied. Thereby that normal profit is calculated. Then from the actual profit minus normal profit, super profit is given. From that it is multiplied with the purchasing years. Then it gives the value of goodwill. Then the sixth illustration means directly they have given the capital employed and the rate of return. Thereby there is no problem in finding out the capital, normal profit. But actual profit needs some adjustment, that managerial remuneration to be given in future. And like that non-recurring, income or non-recurring expenses. Non-recurring expenses means you have to, deduct it. In future you have to. Non-recurring income means non-recurring income. Non-recurring expenses we have to give in future means. Future expenses means that should not we are giving now. Future we have to give means that should be deducted. Thereby the adjusted average profit should be calculated. Then the deductions have been taken from the actual profit minus normal profit, and from that it would multiplied into 2 or 3 times to know the goodwill. Okay, thank you very much. That's all about the calculation of goodwill based on the super profit. Thank you.